Most people think diversification means owning more investments, but some of the least diversified portfolios I see are the ones with the most funds. They've got multiple asset classes, ETFs, individual stocks, but can't clearly explain why they own any of it. So in this video, I want to break down what diversification actually means, where people get it wrong, and how to build a portfolio that spreads risk without overcomplicating everything. Lots of people treat diversification like a numbers game, the more the better, but without properly thinking about what level of diversification they actually want, or what they're even trying to diversify against. There's a common thought about linking diversification to risk. The whole point of spreading our bets is to reduce risk. But what risk are we trying to reduce? Because different risks require different approaches. If this was just about reducing risk, you wouldn't invest at all. And if it was about being as diversified as possible, you'd own everything. At some point, you've got to draw a line. And that's why it's so important before you start adding more investments to think about what risk are you actually trying to mitigate here and find a balance you're comfortable with. Diversification is subjective. You can't say one portfolio is more diversified than another without more context. Let's take the most common example, a global ETF. It's often seen as the default diversified approach. And in one sense it is. You'll have exposure to over 2,000 companies, but in another, you'll also have just under 60% of exposure to the US. That's the nature of market cap weighted indices, where the bigger the company, the more weight it has in the index. And because the US market is so dominant, many global ETFs also end up with a strong tilt towards technology, usually around a quarter of the fund. Then look at the top 10 holdings. For most funds, these account for 20 to 25% of the fund. To be clear, I'm not criticizing global ETFs. For many people, they're still one of the best options out there. Simple, cheap, low maintenance, broad exposure. And most people accept the concentration risk because of how well the US has performed in the last decade. The point is, that's absolutely fine as a decision, but just appreciate that you've taken a decision on your level of diversification. Broad exposure and balanced exposure aren't the same thing. So where do you start? I think this is where many people ask the wrong question. They ask, how do I become more diversified? Rather than, what am I trying to diversify against? Because the more specific you can be with this question, the more aligned your portfolio will be to your actual goals. Think about specific risks to your portfolio. For regional and sector risks, you might decide you want less exposure to US technology because you feel they're overvalued. You may feel equity as an asset class may struggle in the near term, so by adding other asset classes such as bonds, you reduce your equity exposure. Combined with that, you might want to balance volatility because you'll need the money in a few years. Perhaps a mix of investment styles such as growth and defensive, or simply not being too exposed to one currency. These are the kind of risks you need to think about alongside your goals before you can answer, how do I become more diversified? It means the right portfolio can look very different from one person to the next. You can copy someone's funds, but it's unlikely you'll have exactly the same goals, time frame, and risk tolerance. Let me walk you through what usually happens. For a lot of people, they'll start with quite a simple approach. Perhaps it is just one global ETF, but there's usually a big decision between that and the S&P 500 because that's been the dominant market in recent times. So sometimes people will just choose both because they can't decide. Then they'll add a NASDAQ ETF because of how well it's performed. Then the stock market goes through a slow period when things are moving a bit sideways. So they decide they need a dividend fund so they can keep things ticking over. Then they'll read something about India or China and decide they need more exposure to emerging markets. Then maybe they add a home bias with a UK ETF. And before they know it, they've got 6 different ETFs before even adding any different asset classes or individual stocks. This portfolio is no more diversified than the single global ETF they started with. All they've done is add unnecessary overlap. But the real cost isn't just a potentially less diversified portfolio, it's the complexity that it brings with it. More funds means more things to monitor, more decisions, more rebalancing, more temptation to tinker. Is that really what you want as an investor who's got a life outside of the markets? Overlap does get a bad rep, but that's because most people do it without realizing. If it's intentional, that's absolutely fine. You've made an active decision and have clear reasoning. The problems arise when you have a portfolio you don't fully understand and the market drops 20%. Your portfolio is like a relationship. It says, if you can't handle me at my worst, you don't deserve me at my best. The more you understand about why you hold what you do, the less mistakes you'll make when things get rough. So what should diversification actually look like? Let's look at a few examples. If you were to start with a global fund and decided you were happy with sector concentration, but you weren't comfortable with country concentration, there's multiple ways you could reduce US exposure. but one would be to consider a 3-fund approach. You'd select a global fund that excludes the USA and then buy the S&P 500 separately, allowing you to choose a weight you're comfortable with. You'd also likely need a 3rd fund because most global funds that exclude the US are not strictly all-world funds. They also exclude emerging markets. So you'd also hold an emerging markets fund at a weighting of your choosing. If you're approaching retirement, your main concern might be volatility risk. So you'd want to introduce some bonds or money market funds into the portfolio to balance this out. You'd accept this will likely reduce overall returns, but that's not your main priority. In the first example, they could have a much longer time horizon, so they can afford to be 100% equity and ride out any volatility. If you're a UK investor and you decide currency risk is more of a concern than the other risks, then you could opt for a home bias, and you could deliberately overlap a global fund with a UK focused one. Those are all valid reasons to diversify, but the difference is they've clearly identified the risk they're trying to mitigate by diversifying. Every holding in your portfolio should earn its place. It should have a reason for being there. It could be growth, income, lower volatility, fills in an exposure gap, but whatever it is, it should have a clear reason. Write down every fund you own, and next to each one, write one sentence answering the question, why do I own this? And if you struggle to answer, or several funds have the same purpose, you've probably found something to improve. Do this before buying any more investments. There's levels to diversification. It's not just about owning everything. It's about finding a level you're comfortable with, that's in line with your goals, and mitigates the right risks for your situation. Sometimes it'll be one fund, sometimes it'll be a few. There's no one-size-fits-all answer. But remember, more doesn't automatically mean better. Your portfolio doesn't need to be sexy, it just needs to work. I hope you found that useful. Let me know your thoughts down below in the comments, and I'll catch you in the next one.